What do you make of this idea that the Fed and the market appear to be increasingly on different pages about the outlook?
The Fed and the markets are looking at the same data. I think Mike is absolutely right there. I think what really is distinguishing the difference is a different standard of proof. Effectively, the Fed wants to have beyond a reasonable doubt, like you have in a criminal trial, where the market is basically saying preponderance of the evidence, more likely than not, like in a civil trial. So we're looking at the same data. It's the issue of what's the burden of proof. And the market basically is saying, we're at the end of this tightening cycle. It is time to bet what happens next. And the Fed is focused on finishing the cycle.
So who is wrong?
Given the fact they're looking at different standards of proof, neither one is wrong. But from an investment perspective, the market is right.
So you expect interest rate cuts this year?
Yeah, I do. I think the Fed will finish the tightening campaign pretty soon. The market has priced in 3 more 25s. I don't even think we'll get that many. And I think we'll have a pivot, a rhetorical pivot, by the middle of the year. And I'm looking for cutting in the second half of the year, reflecting the fact that inflation is coming down, the economy is soggy, and the Fed is restrictive. This is a pretty easy call.
The cut call, though, it doesn't appear to be very easy. You know, when I talk about it with investors, a lot of the, I'll say, older generation, those who have seen inflation cycles and Fed hiking cycles in the past, say, the young folks have never seen this before. We're going to have higher interest rates for the next few years. This is a whole paradigm shift. And this is a generation of investors that are just used to the Fed coming up and cleaning it up and cutting rates and not staying high for long. So it does feel like there's this kind of fork in the road when it comes to the outlook beyond, say, the middle of this year.
Well, I think both crowds can be right in that you can have a cyclical reversal, but the easing campaign on the other side of this tightening campaign is not going to take you back to zero. Remember, we've got a generation that's grown up of going to zero twice, back in '08 and then obviously in 2020. So the new paradigm is a positive Fed funds rate, even at the bottom of the cycle. And I think that is correct. But it doesn't obviate the need for the Fed to move back from restrictive towards neutral once it has achieved its objective of inflation crying uncle.
Do you think they can get away with ending this tightening cycle without seeing a markedly higher rate of unemployment?
It's hard to tell because unemployment is such a lagging indicator. I think we're going to see the employment side slow in the months immediately ahead, and the unemployment rate's going to go up. How much, I don't know. But from a market perspective, it's not so much how much the unemployment rate goes up, but when the Fed effectively said enough is enough and goes the other direction. The pivot is far more important for the markets than actually what the level of the unemployment gets to, though the opposite is true, obviously, for Main Street.